The next step is to analyze your investments. So how have your investments been performing? Probably pretty good, considering how well the stock market has been performing in recent years. But another way to think about how your investments have been performing is to think about how they have performed against relevant benchmarks. So what are the more common benchmarks? Here is a short list of common benchmarks against which you can assess the performance of your investments. It's important to realize that even if your investments are going up in value, they may still be underperforming against market indexes such as these. Investment performance is also impacted by fees, which you will be paying in some form and at some rate regardless of which investments you hold. So how much are you paying in fees? Do you really have a good sense of this? And what value or benefits are you receiving in return for the fees you are paying? It's not necessarily a bad thing to pay fees, but you want to understand how much you're paying and what value or benefits you are receiving in return for those fees. You also want to determine how your investments will be taxed at distribution and as part of your estate. Some of your investments may be growing at a tax-deferred basis, which is a good thing. But this also means that you are building up a tax liability that will have to be paid at some point in the future. This leads to questions regarding sequencing of distributions and timing of when to pay deferred taxes. Proper tax planning can influence investment decisions and enhance investment performance. You also want to know what your current asset allocation means relative to stock market risk. Are your allocations set up to be more aggressive, meaning in a strong stock market you'll have higher returns, or are they more conservative, meaning that in a good stock market the returns won't be quite as high, but in a bad market or a down market, you would suffer fewer losses? And what's the mix of bonds to securities within your asset allocations? It's thought that the higher your percentage of bonds, the more conservative your allocation, and the higher the percentage of securities, the more aggressive your allocations are. There's also the mix of large, mid, and small cap stocks within your securities allocations. Being invested in large cap stocks simply means that you're invested in larger companies that tend to be more mature and less volatile, tend to pay higher dividends, as opposed to small cap stocks, which tend to be oriented towards growth. They're more aggressive, but can be much more volatile. Among your bond holdings, what percentages are short-term, mid-range, and long-term bonds? If interest rates rise, this will have an impact on the value of bonds going forward. And what is the investment quality of your various bond holdings? There are your government bonds, which are high quality but tend to have lower yields. Then there are different levels of quality for corporate bonds. And then there are high yield bonds which pay more but are of lower quality. The bottom line is, there is no way to predict how the stock market and other asset classes will perform in the future. But by understanding how your money is invested today and how it has been performing, you can make investment decisions that can enhance returns and mitigate losses.